What's up, guys? It's Mr. Fit to Flourish, and welcome to the Fit to Flourish podcast. Today, I wanted to talk about a lot of signs to get in and out of trades. So this is going to be a continuation of the setup video that we talked about the other day. So the first concept that I wanted to talk about today was dissipating pressure. So dissipating buying pressure, which basically means that the pressure to buy is going away or buyers are leaving the market. You can see this by the formation of smaller and smaller consecutive bars. So typically, when you see a large green bar, you'll see that means a lot of buyers are buying and you have buyers present in the market. As green bars get smaller and smaller consecutively, then you'll know that buying pressure is going away, and it's a sign that there's not a lot of strength in buying in the market and sellers are stepping in. Then you'll see topside wicks, which are wicks at the top of a bar after these consecutive small bars form, which means that we're going to probably start going down. And then the same thing is for selling pressure. So if there's big red bars forming, that means there's a lot of selling pressure, a lot of sellers in the market. But as the bars get smaller, that means that selling pressure is going away. So sellers are leaving the market, buyers are stepping in is the term. And then in this depiction, you can see that buyers are stepping in with this long side bottom wick, and sellers are going away. So there's dissipating selling pressure. Typically, you get good buy signals with these long bottom wicks at the bottom of a downtrend. Now, the best signals to get in are bars with no tails at the end. So that means that they closed strong. So that flat part at the top of this green bar, this big green bar, also known as a Maribozu candlestick bar, the flat top means that that's where it closed, but also that there's no wick. So that means that that whole session finished out buying pretty strong. So these are typically the best signals to get into a trade in the upward direction. There are also certain patterns that a lot of traders pay attention to, such as these wedge formations. So an upward wedge like this can show you that you're going to get a downward break. So after that upward wedge finishes forming, price action is going to probably start to go down. And when you get a downward wedge like this, then you're probably going to see that price is going to break up to the upside. Another major concept in price action and price movement is reversals. So what is a reversal? So a reversal is when a trend starts to go in the other direction. For instance, if price is moving up consistently and you see these green bars forming, a reversal is the very top where price starts to move down. So you go from an uptrend to a downtrend. So that would be a reversal. Or if you go from a downtrend to an uptrend. One Wall Street rule to remember is that major reversals typically happen at 10 a.m. Eastern Standard Time and 11 a.m. Eastern Standard Time. Now, these are some major signs of reversals. So long side wicks, smaller bar, micro double bottoms, up down bars, down up bars, micro double tops, trend line breaks, and slingshot dojis. And then here is an example of a reversal. Here is an example of a double top reversal. And some traders refer to double tops as liquidity sweeps, which basically means once you get to the highest point of previous price action, that's an area where sellers are stepping in or people want to get liquid. So a lot of people you might see on YouTube call it a liquidity sweep. It's just a double top. They're just trying to sound smart. A major rule of thumb is that if the market tries to do something 2 times, it's probably going to reverse. So that's why you get a lot of double tops and double bottoms. And at those areas, you'll see major reversals. Here are some examples of up down bars and down up bars, also known as micro double tops and micro double bottoms. These are very good signs of reversals, so keep this in mind. Now, very large bars are termed exhaustion bars. And these bars are extremely large bars where it could be an extremely large green bars where buyers are tired of buying the price up and then they disappear all of a sudden, or an extremely large red bar where sellers are tired of selling and they just give up. Over exhausted bars typically open up trading sessions, and after they finish forming, they're typically a good sign of an immediate reversal. Now, that's all I had for you today, but this is exactly how I made a ton of money trading Tesla the other day, and it's basically by knowing these key concepts when it comes to price action and price movement. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.